Nothing about what you're about to hear took place in a hedge fund office, a government briefing room, or a futures exchange packed with traders staring at screens. There were no emergency rate meetings, no late-night liquidity injections, no cryptic policy leaks. What happened unfolded somewhere far more ordinary, far more familiar, and far more revealing. It happened inside a warehouse. Bright lights, wide aisles, concrete floors, the kind of place where people buy bulk snacks, paper towels, and frozen meals. It happened at Costco. Yes, that Costco. The one you associate with oversized shopping carts and families wandering slowly through aisles on a weekend afternoon. The last place anyone would expect to see a warning signal about the global financial system. And yet, that's exactly what it became. In just 72 hours, Costco sold out of every ounce of silver it had available. Not most of it, not some of it, all of it. Roughly 2.4 million ounces of physical silver disappeared through a single retail outlet in 3 days. No promotions triggered it. There were no yellow clearance tags or limited-time banners urging customers to act fast. The silver simply vanished. This wasn't a gentle flow of buyers adding a bar or two to their cart out of curiosity. This was a surge. Inventory appeared online and vanished almost instantly. Customers refreshed pages repeatedly, watching products pop in and out of availability like concert tickets during a presale. Orders came in so fast that internal systems reportedly struggled to keep pace. Tubes of American Silver Eagles were gone. 100-ounce bars disappeared. Every listing wiped clean. And here's what makes this extraordinary. These buyers were not traders. They weren't hedge funds or metal specialists. They weren't online communities coordinating a squeeze. Teachers, nurses, retirees, people who shop at Costco because they value stability, efficiency, and predictability. People who, until recently, likely never thought about silver at all. Yet suddenly and collectively, they decided they wanted physical metal. Not later. That doesn't happen randomly. That doesn't happen because of a chart pattern or a speculative headline. That happens when something feels wrong. The company has been testing precious metals for a while. It began with gold, 1-ounce bars from well-known refiners. Those sold consistently. Sometimes they sold out. Costco restocked. Then silver entered the picture. Not novelty coins or commemorative items. Real bullion. The same silver serious buyers purchased from dedicated dealers. American Silver Eagles packaged in tubes, large bars sourced from established refiners. At first, the response was muted. Sales were steady but unremarkable. Mostly existing metals buyers noticed. There was no drama. Then, without warning, everything changed. When the numbers were tallied, the scale became impossible to ignore. Roughly 2.4 million ounces moved through Costco in 72 hours. That's about 75 metric tons of silver. That much silver passed through one retail pipeline in a single weekend. Now zoom out. Global silver mine production averages around 850 million ounces per year. Costco shoppers absorbed a meaningful portion of that in a blink. The U.S. Mint sells roughly 15 to 20 million ounces of American Silver Eagles annually. Costco moved the equivalent of about a month of that output in 3 days. Even next to institutional holdings, the number stands out. The world's largest silver exchange-traded fund holds around 500 million ounces. Costco customers bought a noticeable fraction of that, not with leverage or derivatives, but with cash and delivery. That distinction is critical. This wasn't a single entity reallocating capital. It wasn't a fund adjusting exposure. It was thousands of individual decisions made independently by people not known for speculation. Costco customers are famously conservative. They buy in bulk because they want fewer surprises later. They value consistency. They optimize for reliability. When that group collectively decides to convert cash into metal, it's not driven by excitement. It's driven by concern. That tells us several things. First, precious metals are moving out of the fringe. For decades, gold and silver ownership lived on the margins of mainstream finance. You had to distrust institutions or study monetary history deeply to care. Most people didn't. They trusted retirement accounts. They trusted the system to hold. That trust is eroding. Currency debasement wasn't supposed to be a common conversation. Yet now people who maybe never visited a coin shop are deciding that owning something tangible might be prudent. Second, this episode exposes how fragile the physical silver market really is. Costco is massive. Its purchasing power, logistics, and supplier relationships are unmatched. If anyone can source product at scale, it's Costco, and yet they ran out completely. Worse, replenishing supply isn't easy. Refiners and mints face finite capacity. Lead times are stretching. What once took days now takes weeks. You can't rapidly expand a silver supply chain. If Costco can't keep shelves stocked, what does that imply for smaller dealers? It implies availability is an illusion until suddenly it isn't. Third, and this is the most important point, it exposes the growing gap between paper silver and physical silver. While millions of ounces vanished from retail shelves, the quoted silver price barely moved. Futures markets looked calm. Charts showed nothing alarming. Anyone watching only paper markets would have seen no signal at all, but the physical market was under stress. Paper pricing assumes large quantities of metal are readily available near that price. In practice, try sourcing millions of ounces, and you quickly discover that spot prices are theoretical. Premiums rise, delivery times stretch, supply evaporates. The number on a screen looks orderly. The real market is not. That disconnect can persist longer than people expect, until it can't. What happened at Costco doesn't mean silver explodes tomorrow. It doesn't mean markets collapse next week. But it does mean something has shifted quietly. The buyers changed, the motivation changed, the audience changed. When people who normally stock up on paper towels start stocking up on bullion, it's worth paying attention. Markets rarely announce turning points loudly. They whisper first, and sometimes those whispers echo through warehouse aisles. What turns this from a strange retail story into something far more serious is what it says about trust. Markets don't crack because of charts. They crack because belief changes. And belief is changing among people who normally stay as far away from financial drama as possible. Costco shoppers aren't gamblers. They don't chase momentum or debate macro theory online. They focus on practical things: bills, groceries, savings, stability. When that group decides to convert cash into physical metal, it signals a shift in mindset that no spreadsheet can capture. The predictable response from financial media will be dismissal. You'll hear familiar phrases: unsophisticated retail behavior, panic buying, herd mentality, the same language that appears whenever ordinary people move ahead of institutions. But that framing collapses once you look at the details. Costco wasn't selling silver at outrageous prices. There were no novelty markups. These were standard bullion products, priced competitively, often cheaper than specialized dealers. Premiums were reasonable, in some cases lower than local coin shops. Buyers weren't being exploited. They weren't overpaying. They were executing clean transactions at fair market value through a trusted retailer with decades of reputation behind it. No wires to unknown sellers, no mailed checks, no counterparty anxiety. That isn't reckless behavior. It's calculated. The intelligence behind this move has nothing to do with price action. It comes from lived experience. Costco members don't need inflation data releases to know prices are rising. They see it every week at checkout. They don't need housing reports to understand affordability. They feel it when leases renew or mortgage payments reset. They don't need analysts to warn them about energy volatility. They pay utility bills. They fill gas tanks. They live in the real economy, not in projections. And when you live there long enough, patterns become clear. Prices rise faster than income. Savings stretch less. Promises feel less solid. Confidence erodes slowly, then suddenly. So when an opportunity appears to exchange digital dollars for something tangible, finite, and outside policy control, people act. Not emotionally, instinctively. This is where institutional thinking often falls behind reality. Analysts assume retail participants are the least informed. But during periods like this, retail behavior often reflects reality more accurately than institutional positioning. Models assume stability. They assume historical relationships persist. They assume central banks can intervene indefinitely. The average Costco member no longer assumes any of that. And that loss of assumption matters. Fiat systems don't fail because equations say they should. They fail because trust evaporates. They fail when people stop believing that holding cash is neutral or safe and begin seeing it as exposure. When that shift happens, money behaves differently. What happened at Costco wasn't investment. It was migration. Capital moving away from abstraction and toward substance. The location of that migration is critical. If this behavior were limited to niche bullion dealers, it could be dismissed as routine. The same buyers doing what they always do. But this wasn't niche. This was mainstream. Once mainstream behavior shifts, it doesn't quietly reverse. Consider the scale involved. Costco has roughly 60 million members in the United States alone. You don't need all of them to act. You don't even need many. If just 1% decide to buy silver, that's 600,000 people. If each buys a modest amount, say 100 ounces, that's 60 million ounces of demand. Nearly 10% of annual global mine production generated by 1% of one retailer AS customer base. And that's before repeat purchases, before heavier buyers, before copycat behavior spreads. Because once one major retailer demonstrates demand, others take notice. Walmart notices. Amazon notices. Physical silver stops being a curiosity and becomes inventory. Demand doesn't grow gradually after that. It jumps. Supply can't jump with it. Most global silver production is already committed to industrial use: electronics, solar panels, medical applications. Investment-grade silver is a much smaller slice of the total supply. Under normal conditions, only a few 100 million ounces are available annually for investment. If mainstream retail demand doubles or triples that figure, the math stops working. Refineries can't scale overnight. Mints can't triple output without years of investment. Logistics don't accelerate because sentiment changed. Instead, friction emerges. Premiums rise, delivery times stretch, inventory becomes inconsistent, dealers limit quantities, listings disappear. We're already seeing the early stages of this. Costco sold out, restocking lags. Other dealers quietly extend lead times. This is happening before any dramatic price event, which leads to the next phase. The first phase is awareness. That's where we are now. Retail demand surfaces, localized shortages appear, prices on screens remain calm, institutions remain indifferent, then visibility arrives. Scarcity attracts attention. Media coverage follows shortages. Stories about unavailable products circulate. Curiosity becomes urgency. People who never considered silver start asking questions. Shortages become headlines. Headlines attract buyers. Buyers deepen shortages. At that stage, premiums detach entirely from spot prices. The posted number becomes symbolic. Physical silver trades where it must. The gap can no longer be dismissed as temporary. This is when larger players step in. Arbitrage looks tempting. Buy futures, take delivery, sell physical at a premium until they attempt it. Taking delivery at scale is where paper markets reveal limits. Registered inventories aren't endless. Delivery systems weren't designed for mass conversion. If enough players attempt delivery simultaneously, the system clogs. When that happens, exchanges face an uncomfortable choice. Allow prices to rise sharply or settle contracts in cash. Neither option preserves confidence. One exposes scarcity, the other confirms it. After that, intervention becomes likely, not because authorities care about silver, but because credibility matters. Markets built on trust don't survive visible fractures. Restrictions appear, rule changes follow, temporary measures are introduced. History shows this pattern clearly, and intervention tends to backfire. Attempts to discourage ownership often validate the reasons people wanted to own something in the first place. Nothing fuels demand like the suggestion that access could be restricted. Eventually, after confusion and response, markets do what they always do. They reprice. Not based on narratives, not on models, on availability, on what can actually be delivered. That repricing is rarely gentle. And when people look back at how it started, it won't be traced to a policy memo or emergency announcement. It will trace back to a warehouse club quietly selling out of silver while the paper price barely moved. Sometimes, the most important warnings don't come from economists, policymakers, or financial headlines. They surface quietly in places no one thinks to watch. They emerge from everyday behavior, not official statements. That's why this episode matters far more than it first appears. At some point, prices stop being anchored by theory and start being dragged by reality. Silver is approaching that point. Whether it eventually stabilizes at $100 an ounce, $150, or $200 is impossible to forecast precisely. That outcome depends on how deeply confidence in paper markets erodes and how much capital migrates into physical metal. But one thing is clear. $30 silver does not survive a genuine, sustained physical shortage. It simply can't. Prices rise until demand breaks, until casual buyers step away, until only committed participants remain. Silver has a unique challenge. Unlike many assets, it isn't optional. It's embedded in industry. Factories don't pause production and wait for prices to calm down. They pay what they must to keep operations running. When a material is both an investment asset and an industrial necessity, the ceiling is far higher than most people expect. This is where Costco becomes more important than it seems. Costco isn't just a retailer, it's a demographic signal. Its customer base represents the economic middle, the group that holds the system together, not the ultra-wealthy, not the desperate, but the broad population that pays taxes, carries mortgages, and keeps consumption moving. When that group begins buying silver in what can only be described as defensive quantities, anxiety has crossed a threshold. People aren't just uneasy anymore. They're preparing. And here's the paradox that always appears at this stage. When large numbers of people prepare for something to go wrong, they often accelerate the very outcome they fear. This is how financial panics actually unfold. If people worry about currency instability and respond by buying physical assets, they drain supply. Draining supply exposes the fragility of paper systems. That exposure forces repricing. Repricing triggers broader instability. Fear doesn't just predict the crisis, it helps create it. In that sense, Costco functions as an early warning system, a very boring, very efficient canary in the coal mine. 2.4 million ounces gone in 72 hours is that canary making noise. It tells you people sense risk, even if they can't articulate it in economic language. Ignoring that signal because it comes from retail is how people get blindsided. So what do you actually do with this information? First, understand that this isn't about chasing a trade or guessing next month's price. This is about positioning for a structural shift. The Costco Sellout suggests we are entering a phase where physical precious metals are no longer fringe hedges, but mainstream defensive assets. That kind of transition doesn't resolve quickly. It unfolds over years, not weeks. A 3 to 5 year horizon is realistic. Second, if you don't already own some physical silver, this event should register as a wake-up call. not because silver guarantees wealth, but because it functions as insurance. That's how Costco buyers are approaching it. They aren't speculating. They're hedging uncertainty. Holding a portion of wealth in something tangible, outside digital ledgers and counterparty risk, makes sense when the system itself shows stress fractures. How much is appropriate depends on individual circumstances, but a commonly cited guideline is 5 to 10% of net worth in physical precious metals. For someone with $100,000 in savings and investments, allocating $5,000 to $10,000 to silver or gold is not extreme. Historically, it's conservative. Third, accept that premiums are unlikely to return to previous levels. The era of buying silver for a couple dollars over spot is probably over for widely traded products like Silver Eagles or generic rounds. Premiums of $5, $8, even $10 may become normal. Larger bars may still carry lower premiums, but even those are rising. This isn't manipulation by dealers. It's tight physical supply expressing itself. Waiting for premiums to collapse may mean waiting until the entire issue resolves. By then, the opportunity to protect yourself may already be gone. Fourth, be realistic about timing and delivery. Larger orders often come with long lead times. 6 to 8 weeks is already being quoted in some cases. That's not a reason to delay. Locking in an order and waiting is far better than trying to buy during a full-blown panic when inventory disappears or prices jump overnight. The Costco buyers, who acted during that 72-hour window, didn't wait for confirmation. They moved early. That's why they received metal. Fifth, if you're building a position, spread purchases over time. No one knows whether silver dips into the high 20s or spikes into the 40s in the near term. Dollar cost averaging removes the need to be right on timing. Buying consistently smooths volatility and builds exposure steadily. That's disciplined accumulation. Sixth, think carefully about storage. Physical ownership carries responsibility. Don't leave metal in obvious places. A properly secured safe or professional storage facility offering allocated, segregated storage matters. Avoid bank-safe deposit boxes. During banking disruptions, access isn't guaranteed. Control matters. Seventh, practice discretion. This isn't paranoia, it's common sense. Advertising ownership of precious metals creates unnecessary risk. Tell your spouse. Tell a trusted advisor if appropriate. Don't broadcast it. Operational security becomes more important as economic conditions deteriorate. Eighth, expect volatility and prepare emotionally. Silver is not a smooth asset. Prices can swing violently. You might buy at 35 and watch it drop to 28. That doesn't invalidate the rationale for owning it. Insurance doesn't stop being insurance because premiums fluctuate. Costco buyers aren't day trading. Their concern is systemic, not tactical. Ninth, stay observant. Watch what happens when Costco restocks. If inventory disappears again quickly, that's confirmation. Watch other retailers. Watch premiums and delivery times. Rising premiums and longer lead times aren't noise, they're data. If those signals persist, the shortage narrative strengthens. Finally, understand the endgame. At some point, trends like this reach critical mass. It might be triggered by a delivery failure, a policy response, or a currency event. When that happens, physical silver won't just be expensive, it will be unavailable. Dealers will stop quoting prices because they can't source metal at any level. At that stage, premiums become meaningless because supply is zero. If you don't already own silver, you won't be able to acquire it. That's why the window is now. Not when mainstream media runs constant coverage. Not when regulation discussions begin. Now, when the story still sounds niche and slightly boring. What happened at Costco wasn't random. It wasn't a fluke. It was a signal. Regular people, people who never cared about precious metals before, decided in large numbers that holding physical silver made sense. They acted decisively enough to drain millions of ounces in days. One retailer, one weekend. Imagine what happens when this behavior spreads. Imagine when every major platform tries to meet the same demand. The math fails. Supply can't keep up. Prices rise until demand finally breaks. That isn't prophecy, it's supply and demand. The Costco buyers who moved early will look prescient in hindsight. But hindsight is expensive. The lesson is already visible. The only question is whether you recognize it now, or whether you'll only understand it later when silver is triple digits and impossible to find at any price. The window isn't closed yet, but it isn't wide open anymore.